All right, let's go ahead and get started. Welcome everyone. Welcome to our webinar on the Goodwill and Impairment projects. Before we begin, I'd like to go over a few housekeeping rules for this session. Mics and webcams are turned off except for today's speakers. Please do not switch them on as we'd like to guarantee a good internet connection. Today's session will be led by Nick Anderson and Craig Smith. We will have a Q&A session at the end of the webinar. However, please feel free to use the chat to ask any questions you may have during the presentation. You'll also be able to ask your questions by clicking on the raise your hand icon that's available in the participant tab. I'll then call on your name and ask your question. Let's go ahead and give it a try. Could you all raise your hands if you understood the housekeeping rules? Let's give it a few seconds. So it's in the participant tab, the raise your hand. Great, I'm starting to see a couple blue hands. Wonderful, great, thanks. Bernard Coupé, Advocacy Managing Director of CFA Society France, will now introduce you to our two guest speakers today.
So thank you, Marie-Alix. We have the pleasure today to speak about a crucial question for investment professionals, particularly the question of how to treat the acquisition process in our view, and how the management of a company can explain the objective behind this acquisition. And in this subject, the IASB and the board of IASB in particular try to obtain feedback about this subject, and that was the purpose of this webinar. And we have the pleasure to have a speaker, two very qualified persons. The first one is Nick Anderson. Nick was appointed as a member of the International Accounting Standard Board in 2017. He has 30 years of practical activity, mainly as a buy-side investor, using and supporting the development of high-quality financial reporting. And the second speaker will be Craig Smith, and Craig is a technical staff member at the IASB, working in the Goodwill and Impairment project. And before joining the technical staff in 2016, Craig worked as an auditor of financial services companies at Deloitte and BDO. And we had a third speaker, but it will be not sure that she can join us, but I'll just mention it because she accepted to contribute to this webinar. And this person was Françoise Florence. And Françoise joined the International Accounting Standard Board in 2017. She was almost 40 years of activity in company financial reporting and in standard setting. She served also as Chief Executive Officer of the European Financial Reporting Advisory Group, EFRAG, that we know in this subject. So the subject is particularly crucial for us, and the suggestion from the IASB board should be observed and detailed by all the investment professionals in order to see if this improvement could be adequately for our activity. And we will try to not only to obtain views about that, but also we will ask you to contribute by answering to our survey. Thank you to all of you for joining us. And now I let the floor to Nick for starting the meeting. Nick, the floor is yours.
Good afternoon, and thank you, Bernard. Thank you, Marie-Alix. Thank you to CFA France for hosting this seminar, this webinar this afternoon. Bernard mentioned that Françoise, unfortunately, is unable to participate, but Françoise is observing the meeting and very much interested in your views. So in this webinar, we will give you an overview of our discussion paper, Business Combinations, Disclosures, Goodwill and Impairment, which the board published in March this year. The next slide just shows some housekeeping points. As with all of our presentations, any views expressed today are our own views and not necessarily shared by the rest of the board or the IFRS Foundation. We will pause during the presentation to ask you some polling questions. We're very interested in your views, and there'll also be an opportunity for you to ask questions at the end of the presentation. So just to remind you, the IFRS Foundation's mission is to develop IFRS standards that bring transparency, accountability and efficiency to financial markets around the world. Our work serves the public interest by fostering trust, growth and long-term stability in the global economy. This slide shows the reach of IFRS standards globally. Required in over 140 countries today, permitted in another 12 countries such as Switzerland and Japan, whereas nations such as China and India are on a convergence path to full IFRS, so significant reach. Slide 5 provides some background about the CFA Institute's interactions on the topic of goodwill. Now, most of these interactions have been with our US equivalent, the FASB. One thing that we thought was interesting in the CFA's letter earlier this year to the FASB was information about the size of goodwill balances in the US. So we did a little research ourselves and obtained similar information for France, plus information about the gross size of M&A deals that closed in 2019. And we took that information from Capital IQ, and these are shown on the slide. And you can see that goodwill makes up around about 1/3 of the net assets of companies on the CAC 40. So that's a little less than what the CFA Institute calculated in the US, but it's clear goodwill balances are still significant. Slide 6 provides an overview of the board's project on goodwill and impairment. And perhaps the first thing to highlight is that the discussion paper is not just about goodwill, but it also deals with improvements to disclosures that companies provide about M&A transactions. And we think that's very important for investors. This project started after the board reviewed its standard that deals with M&A, IFRS 3, which was issued in 2004. And the objective of the project was to improve the information that companies provide to investors at a reasonable cost about the businesses those companies buy, helping investors hold management to account for those acquisition decisions. The board published the discussion paper in March, and although we're at an early stage in the board's process, it's still important that we hear what people think about the board's ideas, and especially what you as investors think about the new disclosures. And it's also an opportunity to explain what you think about goodwill. Should it be amortized or not? So just to remind you, the deadline for submitting formal comment letters on our proposals is the 31st of December this year. Slide 7 summarizes the feedback that the board heard during the project about various aspects of accounting for M&A transactions. Now, some of these concerns relate to the impairment test for goodwill, that it is costly and it's complex, or it doesn't recognize impairment losses on a timely basis. Investors have said they would like to see more information provided in the financial statements on the subsequent performance of acquisition. And the board also received some feedback that it should reintroduce the amortization of goodwill, and that it was difficult to recognize some intangible assets separately from goodwill in a business combination. So those assets, those intangibles that are only recognized under IFRS 3, i.e. in a business combination. Slide 8 summarizes the board's views that are presented in the discussion paper in response to that feedback. And these cover 3 main areas. So the first of these relates to disclosures. The board is proposing to require companies to disclose information about how acquisitions perform after the transaction. It is proposing to make some improvements also to the current disclosure requirements about M&A transactions. The second area relates to improving the accounting for goodwill. So the board explored at length whether it could make the impairment test more effective, but it concluded that was not feasible to do to improve the test significantly at a reasonable cost. The board then considered whether to propose reintroducing amortisation, and the board's initial view is that it should not do so. And that's because there is no compelling evidence that doing so would significantly improve financial reporting. Finally, as a board, we considered and explored some possible simplifications that would reduce the cost of performing the impairment test by removing the requirement to perform the test annually and amending how value in use is estimated. The third and final area relates to some other topics. The board thinks it should require companies to provide a number for total equity excluding goodwill on the balance sheet. The board also thinks it should retain the current approach of requiring companies to recognize identifiable intangibles separately upon acquisition, rather than subsume some of these intangible assets into goodwill. I should also emphasize the views in the discussion paper are initial views. It depends on the feedback and the comments that the board receives, and from their outreach and from comment letters, the board may decide to reconsider some, all, or some of these views. So moving on to slide 10, we'll begin to take a look at those views in a little more detail. So one of the key messages that the board heard from investors is that companies generally do not disclose sufficient information to allow investors to assess how well an acquisition has performed after the acquisition date. Investors want to hold management to account for their decisions to acquire those businesses. Most investors told us they need that information for stewardship purposes to help them, for example, determine whether they can trust management with further capital. So our existing standards do not specifically require companies to disclose such information. And hence today, that information tends to be provided on a voluntary basis. So in response, the discussion paper explores whether to require companies to disclose information on the subsequent performance of acquisitions in their financial statements. The board thinks it should require companies to disclose three things in the year of the acquisition. Firstly, the strategic rationale for the acquisition. Now, we think that rationale would be a high-level statement that links the acquisition to the company's overall strategy. This strategy may be set out elsewhere in the company's annual report, perhaps in its management commentary. The second thing is the key objective of the acquisition, these being more detailed aims that management intend to achieve as a result of the acquisition. And the third area would be the metrics and targets that management will use to assess the extent to which those key objectives are being achieved. Importantly, in subsequent periods, the company would disclose the acquisition's actual performance based on those metrics to enable investors to assess to what extent those key objectives identified at the acquisition date are being achieved. So what kind of information do companies need to disclose in the subsequent years? If we turn to slide 11, we start to address that question. Now, there's a wide range of different types of acquisition, and they serve a wide range of purposes. And against that background, the board concluded there was no single metric that would be suitable for every M&A transaction. So the board decided to explore instead a management approach. So in other words, the metrics disclosed would be those metrics that a company management uses internally in monitoring the achievement of those objectives. Such measures could be operational, they could be financial, they could be a mixture of both. Now, because M&A quite often involves very large sums of capital and high levels of execution and integration risk, the board presumes that most companies are monitoring their major acquisitions. But what if management are not monitoring an acquisition? Here, the board believes that the company should disclose that fact rather than the board prescribe a minimum set of information to be disclosed. We think there'd be information value if a company wasn't monitoring acquisitions in that way. So I've mentioned management several times. What do we actually mean by management? And here we use something called the Chief Operating Decision Maker. And this is a term which is used in segment reporting to identify the disclosures which are required for segment reporting. And that comes under another of the board's standards, IFRS 8. And so the Chief Operating Decision Maker is the person or function that is responsible for allocating resources and assessing the performance of the operating segments of the company. So the main reason why the board is suggesting using the Chief Operating Decision Maker as a threshold in this new context is so that companies disclose the most important information about the most important acquisitions. A lower threshold might result in excessive and costly disclosures, particularly for companies that make many acquisitions. However, the board would like to hear feedback on whether using this benchmark, using the Chief Operating Decision Maker as a threshold, would lead to companies disclosing all the material information that investors need about acquisitions, the information they need to know about. For the remainder, for brevity, we won't continue to refer to the Chief Operating Decision Maker, but we'll just simply refer to management. So, how long should companies need to disclose this information? The board thinks that companies should continue to provide the information as long as management continues to monitor the acquisition to see that those objectives are being met. The board is aware, however, that information about the subsequent performance of acquisition becomes less relevant over time, and eventually acquired businesses are very often indistinguishable from the rest of the business just as integration occurs. But nevertheless, the board expects management to be aware of how well an acquisition is performing in at least the first few years after that transaction, and therefore expects companies to provide information at least in the year of the acquisition and 2 subsequent annual reporting periods. If a company stops monitoring an acquisition at any time within this timescale, it would need to disclose the reason for doing so. So we've heard various concerns about providing this information. For example, what if the acquired business is integrated into existing business post-acquisition? Now, the answer here depends on how management is monitoring the success of the acquisition. So, for example, if management are monitoring the performance of the acquisition using information about the combined operation rather than just the acquired business in isolation, the company would disclose information on those metrics about the combined operation because that's what management are using. So the principle here, again, is to disclose the information that management uses internally to monitor acquisitions. The board's not expecting companies to create disclosures to satisfy these requirements, but to disclose the information that management are already using themselves. Now, the discussion paper also highlights other concerns that the board has heard, and these include about whether the information is commercially sensitive and whether it's verifiable. And in this consultation, the board is exploring these concerns and hopes those raising these issues will find ways to address them. So from the board's view, it's a reasonable request for investors to ask companies to provide information to help them understand better how an acquisition is performing. So investors' views on whether they need information about the subsequent performance of acquisitions and whether indeed you think the board's approach will provide useful information will be really important for the board as how it decides to proceed from here, whether we should implement these ideas. The discussion paper, as I mentioned earlier, also includes some proposals for targeted improvements to existing disclosure requirements in IFRS 3, and these are summarized on slide 12. And there are 3 proposals I would like to highlight. So the board's view is that it should require companies, firstly, to provide quantitative information about the synergies at the date of acquisition, assuming management expect these when they entered into the acquisition. Now, this change is made mainly in response to feedback that synergies are often cited as a key reason to justify the price that is paid. However, there's often little to no information provided about the benefit in the financial statements. So the board thinks it should require companies to disclose the amount or the range of amounts of synergies expected from an acquisition. Secondly, it should require the separate disclosure of pension and debt liabilities of the acquired business at the acquisition date. This disclosure is proposed because many investors have told the board that they view pension and debt liabilities of the acquired business as part of the capital employed for the acquisition. They therefore need the information to allow them to assess the return on capital employed, and that companies do not often provide this detail. And thirdly, whether we should amend the actual and pro forma financial information that companies disclose about acquired businesses in the year of the acquisition. So what the board is proposing to do is to replace the requirement to disclose profit or loss with a requirement to disclose operating profit or loss as is defined in the primary financial statements project the board is currently running. The board is also proposing that companies disclose the amount of operating cash flow. The board considered other ways of providing pro forma information since feedback indicated due to a lack of guidance, companies prepare the information in different ways. However, the board decided not to change this, but the board's again interested in feedback on whether it should provide guidance or require companies to disclose the basis of preparation for this information. So that summarizes our key proposals in terms of disclosures. And now if we could turn to the polling questions, we have 4 polling questions for you around the disclosures, and hopefully we can see those on the screen in a moment. So here they are. So great if we could get your responses to these 4 questions. So the first question is, do you currently get enough information about the subsequent performance of acquisitions? Do you get that in financial statements? Do you get it in a company's management commentary, in another form of company communication? Perhaps you don't get sufficient information or you don't get information about management's expectations at the time of an acquisition or the subsequent performance of acquisitions. So question 1's about the information that you get today. The second question is, in your experience, the extent to which management are able to answer investor questions about the subsequent performance of acquisitions. So whether this is disclosed or not formally in your dialogue with management, the ability of management to answer your questions on how well an acquired business is performing or not. And then the third question highlights or asks, if we were to require information about the subsequent performance acquisition, should it be based on the information that management reviews itself? Is that an acceptable approach? Or should we be setting some metrics ourselves as a board? Or is there another way of doing this? And the fourth question talks about how we plan to look at the subsequent performance of an acquisition, how companies expect to benefit from that acquisition, the extent to which the acquisition is meeting management's objectives, and the simple question here, whether or not this describes the information that you need. So let me just give you a moment to ponder those questions. And I'll ask Mary Alex to give me an indication when we're ready to move on or have some answers.
Let's give it a few more minutes. I see people are starting to answer the questions. Feel free to ask any questions in the chat concerning the poll, if you have any. So we're just waiting on a few more to answer.
Perfect.
Don't be shy to answer. This is an anonymous poll. All right, so I'll publish the results.
Great. So, okay, overwhelming response, or majority response to the first question, that information about management expectations, most of you think is largely happens, talked about at the time of acquisition and not subsequently. There is, some of you find there is some subsequent information in financial statements and other forms of company communication, but clearly this is a big issue given the amount of capital that is deployed in M&A activities by corporates. And then in terms of management's ability to answer those questions, clearly on most of you believe management is sometimes able to answer those questions, or 50% of you. Some of you think they can usually answer it, but it clearly indicates that quite often management do have information, but it isn't formally disclosed. So I think that's interesting. In terms of our approach, split views here. So yes, the proposal is a pragmatic approach, balancing the benefits with of disclosure with the cost of providing it. But equally, quite a few suggesting that this should be, in terms of the materiality judgments, this should also be through the eyes of management. And so we'd leave it more open in terms of defining materiality rather than using the chief operating decision maker. I'm relieved that almost all of you think that at least we're thinking about the right questions and issues and information that you acquire in question 4. So thank you very much for those responses. They are exceptionally helpful as we continue our work and our deliberations here. With that, let me pass over to Craig.
Thanks, Nick. So if we turn to slide 14, then we'll now discuss the other main topic in the discussion paper, which is the subsequent accounting for goodwill. So before we started into what's in the discussion paper itself, I wanted to give you all a bit of background as to how goodwill is actually currently tested for impairment. And so an important point to mention is that the impairment test isn't actually a direct test of goodwill. Goodwill doesn't generate cash flows on its own. It can only generate cash flows in combination with groups of other assets. And so we can only test it for impairment with those other assets. And therefore, the impairment test of goodwill is actually an indirect test. The unit of account is really the group of assets that we're testing. When an acquisition is made, goodwill is allocated to what we call cash generating units, or CGUs. A CGU is a group of assets that generates cash flows independently of other groups of assets. So you could think of it as a lower level business unit. For example, in retail, a CGU might be an individual shop. The use of CGUs means that an entity might be allocating goodwill to a business unit that already exists within the business, rather than testing acquisition directly, because, for example, the acquired business is integrated into that existing business. A company is required to allocate goodwill to the lowest level that management monitors that goodwill. And so in the example on the slide, perhaps the company doesn't monitor the goodwill of CGU 4 and CGU 5 down at the bottom there. So any allocation of goodwill between them would be arbitrary. Instead, management monitors those two CGUs as a group. The impairment test for goodwill, in that case, will therefore be at the level of group of CGUs X. The highest level that the impairment test can be performed at is segment level. So the company in this instance can't test goodwill at the group level. It has to do it at the minimum of segment A and segment B, depending on exactly how management internal monitoring is set up. So the test requires a company to calculate the recoverable amount of the assets in the CGU or group of CGUs that management's testing. The recoverable amount can be made using assumptions based on what management plan to use the CGU for. This is what we call value in use, or it could be a market-based fair value measure. Either way, the higher of those two amounts is then compared to the book value of the assets in the CGU or group of CGUs. If the recoverable amount is lower than the book value of the assets, the company first reduces the amount of goodwill attached to the CGU. If the recoverable amount still exceeds the book value, once goodwill is being reduced to zero, the company then reduces the value of its other assets in the CGU. So we then turn to the next slide, where we'll talk about the actual discussion paper itself then. Two key pieces of feedback that the board heard about the impairment test were that impairment losses are recognised too late, by which we mean investors have often reflected reductions in valuations of companies long before impairment losses are actually recognised by companies' management. The second thing is that some people said that the impairment test is costly and complex. So in response to this feedback, the board explored whether it could make the impairment test more effective at recognising impairment losses on acquired goodwill on a more timely basis. And we'll look at the board's work in that area first, and then we'll take a look at the board's view on where to reintroduce amortisation and on its efforts to reduce the cost and complexity of the test. So the board identified two possible reasons for the too late issue. So firstly, that cash flow forecasts might be too optimistic, and secondly, shielding. On the first issue, the board's standard on impairment testing, which is IAS 36, it already requires management to use forecasts that are reasonable and supportable. It requires management to assess the reasonableness of assumptions by examining the causes of differences between past forecasts and actual cash flows, and also to disclose information about the assumptions that management used in the test, provide investors with information to assess the reliability of the impairment test. The board's view is that if forecasts are still too optimistic given those requirements, then this is really an implementation issue, and that's better dealt with by auditors and regulators rather than through any additional standard setting. So the next slide, slide 16, explains the second issue, which can lead to impairment losses on goodwill not being recognised when some think that they should be, which is shielding. So I'll briefly explain how shielding contributes to the too late issue. So shielding occurs because in most cases, as we mentioned earlier, the acquired business is integrated with some other part of the acquirer's business. Often this is to achieve synergies that management expect from a business combination. Where that other part of the acquirer's business has significant what we call headroom, by which we mean its value exceeds the book value of its recognised assets, then when you're testing that combined business for impairment, the headroom of the existing business is shielding the acquired goodwill from impairment, and therefore, even if the acquisition isn't performing as expected, an impairment loss might not be recognised. The company will only recognise an impairment loss on acquired goodwill only if all the headroom of the existing business has been used up. Moving on to slide 17, to try to fix, in part at least, the too late issue, the board looked at an approach to try and reduce that shielding effect. And what that approach did was it would incorporate the headroom into the impairment test. And so the approach prevented the prior period headroom from automatically absorbing any reduction in the value of the combined business. Although the approach attempted to allocate at least some of the reduction in value to the acquired goodwill, any allocation will still be imperfect. That's because, as I mentioned earlier, it's not possible to tell how much the reduction relates to the acquired goodwill and how much it relates to the unrecognised headroom, because we can't actually measure goodwill directly. And in addition, the board found that this approach would be costly to apply in practice. And so the board therefore concluded that it's not really feasible to design a different impairment test that's significantly more effective than the current impairment test in IAS 36, at least not at any reasonable cost. The board accepts that the current test isn't perfect, but because goodwill has to be tested with some other assets, some degree of shielding is always going to occur. The test will not always, therefore, provide a signal of how well the acquisition is performing, but this doesn't mean that the test has failed, as some people say. Although cash flow forecasts will always be judgmental, applied well, the test should meet its objective of ensuring the book value of the group of assets that's being tested is recoverable. The disclosures proposed on subsequent performance that Nick talked about earlier is the board's way of providing better information about the performance of an acquisition, and that will be better information than the impairment test can provide. And in fact, actually providing information about subsequent performance of acquisitions is not necessarily the main purpose of the impairment test. So we move on to the next slide. During the review of IFRS 3, the board heard feedback that it should reconsider amortisation of goodwill, because amortisation provides a simple mechanism that targets goodwill directly. The board therefore explored whether amortisation of goodwill should be reintroduced. This slide lists some of the arguments for amortisation and some of the arguments for the impairment-only approach that proponents of the two views put forward. The discussion paper contains a fuller discussion of the arguments for both of these approaches. And the more experienced analysts listening are probably aware of the issues, a long history of debates on this particular topic. So before I go through some of these supporting arguments, I just wanted to clarify that when we do talk about the reintroduction of amortisation, this would be with an impairment test as well. So it's amortisation plus impairment versus an impairment-only model. So those in favour of amortisation argue that the review of IFRS 3 demonstrated that the impairment test isn't as rigorous as the board expected and doesn't provide as much information to investors as the board expected. Because of shielding, carrying amounts of goodwill can be overstated, and so the test doesn't help in holding management to account. Some argue that an amortisation expense in the income statement would hold management to account, reporting companies as profitable only if those companies generate enough profit to cover the expense. Some argue that goodwill is a wasting asset and amortisation is the only way to show the consumption of that goodwill and to prevent internally generated goodwill being recognised in place of the acquired goodwill as it's consumed. Although it's hard to estimate the useful life of goodwill, some argue that it's no harder to estimate than for other assets. And some argue that amortisation takes pressure off the impairment test and ultimately reduces the cost of performing the test. But on the other hand, those in favour of the impairment-only approach argue that the impairment test provides more useful information than an arbitrary amortisation expense. Although this information might only be confirmatory, they say it's still more useful than an amortisation expense that most investors would ignore, and unexpected impairment losses do occur and can have a significant effect on a company's share price. Some argue that the impairment test is working as expected. The objective of the impairment test is to ensure the combined book value of the group of assets, including goodwill, the management are testing, isn't higher than their fair value. And if applied well, the test does meet that objective. Also, when developing IFRS 3, the board was aware of the shielding issue, but concluded then, when IFRS 3 was issued, that the test is in fact still rigorous. Some argue that goodwill is not a wasting asset with a determinable finite life. Companies acquire businesses with an expectation that acquired goodwill is maintained indefinitely. Some argue that even if goodwill is amortised, an impairment test would still be required, and amortisation would therefore not significantly reduce cost. The board's view that it should retain the impairment-only approach was by a narrow majority. The board was quite split on this topic. However, the majority views that there's no compelling evidence that changing back to an amortisation model would be a significant improvement in financial reporting. And it's not simply about which model is better, but whether there's compelling evidence that change is needed. Given the narrow vote, the board does welcome feedback on this topic, but just repeating well-known arguments won't move the debate forward. Instead, the board is looking for feedback that provides new evidence or arguments, or perhaps reasons why previous arguments are more relevant now than they were back in 2004. And investors' views on the usefulness of the different approaches will be an important factor in this debate. So in response to the feedback that, can we move to the next slide? In response to the feedback that the impairment test is costly and complex to perform, the board considered whether there are ways of reducing the cost of performing the test without significantly impacting its robustness. And this is on slide 20. Thank you. So one of the reasons given for the cost of the test by companies is the requirement to perform the test even when there's no indicator of impairment. And so the board proposes in the discussion paper that it should remove the requirement to perform a quantitative test annually, but companies would still need to assess at each reporting date whether there's an indicator of impairment, and if such an indicator exists, the company would then have to go on and perform that quantitative test. the change should reduce costs for companies, but there's mixed views as to the extent of this cost reduction. And there's also mixed views as to the effect this would have on the robustness of the test. Some believe this introduces further judgment into the test, whereas others believe that the reduction in the robustness of the test would be marginal, and that performing a test when there's no indicator of impairment is unlikely to identify a material impairment. This was another proposal where the board's majority was narrow, but the narrow majority did consider the reduction in cost being significant and would help to offset the cost of some of the disclosures that Nick talked about earlier, and the reduction in the robustness of the test being marginal. The board also considered some simplifications to how value in use is estimated, removing the restriction in the standard from including cash flows from an uncommitted restructuring or from enhancements or improvements to assets in cash flow forecasts, and also allowing value in use to be estimated using post-tax cash flows and a post-tax discount rate. And this should also reduce costs for companies, while perhaps even making the test easier to understand. So now we'll have two more polling questions, if we can launch them on the slide. Yeah, so there they are. So the first question we have here is, which method of accounting for goodwill provides you with the most useful information? So we've got an amortization plus impairment model, the current impairment-only model, or we've got some other options that we've heard from some investors, maintaining goodwill on the balance sheet with no impairment or amortization, or some say that goodwill basically has no value and it should just be written off at the time of the acquisition. And the second question is, trying to get at whether you think the too little too late issue that the board heard during the PIR of IFRS 3 is really a problem for you. Or so are you actually concerned that impairment losses on goodwill aren't recognised on a timely basis or not? It's a simple yes or no question. So we'll give you a few minutes to answer those questions.
Still waiting on a couple more people.
Thank you. Hopefully we've managed to get a response from everyone.
And I think just 10 more seconds and we should be good. Okay.
Okay, so if you look at the results then, it's fairly similar to what we actually hear from many investors, is that the impairment-only model has a majority, a very narrow majority lead. So it's, I guess, kind of similar to the board in that respect. Some people preferring an amortization to be reintroduced, and an even smaller number suggesting that goodwill should just be written off in the type of acquisition. The second question is interesting because I guess it kind of contrasts a little bit with the first question, and that the majority of participants here are saying that you are concerned that goodwill impairment losses aren't being recognised on a timely basis, and it might be interesting to explore in the Q&A when we get to the end why some of those obviously still support the impairment-only approach. So that's, I think, interesting questions. Thank you. I think we can probably move on to the next section in that case. So if we move on to slide 22, then there's two more topics included in the discussion paper that I want to briefly touch on now. Firstly, it's the board's view that companies should present on their balance sheets the amount of total equity excluding goodwill. The board's view is that such an amount could be a useful flag to investors to highlight companies for which goodwill is a significant proportion of, or perhaps even more than, their total equity, We're already aware that many, but not all analysts calculate measures such as tangible book value for companies in certain industries. And the board also considered whether companies should subsume some intangible assets within goodwill rather than recognizing them separately in a business combination. The board heard feedback that questioned whether the separate recognition of some identifiable intangible assets was actually useful, where those intangible assets are difficult to value reliably, or where distinguishing some intangible assets is costly and or complex and subjective. Some also questioned why some intangible assets are recognized separately in a business combination, but the same intangible asset wouldn't be recognized if it was generated internally. However, views heard by the board were actually mixed. So some actually said that separate recognition of all these intangible assets does provide useful information, helping them to understand what a company actually paid for, and that separately recognizing intangible assets with finite lives rather than subsuming them into goodwill, which isn't amortized, is more useful. The board's view is that there's no compelling evidence to change the recognition criteria for identifiable intangible assets in a business combination, given these mixed views. Considering the concerns of those investors who want to align the accounting treatments for acquired and internally generated intangibles is beyond the scope of this particular project. But the board does encourage those investors who want the board to consider adding a broader project on intangible assets to respond to the board's agenda consultation, which is a consultation that the board holds every 5 years to support its long-term planning. So if we move on to the next slide, this summarizes the board's views and how they line up against slide 24, how the board considers its views as a package of interconnected views and rather than as individual views to be considered only in isolation. So overall, the board's views and the board's opinion would provide better information to investors about acquisitions and will help investors to hold management to account for acquisition decisions, both through the disclosures and the subsequent accounting for goodwill. But it'll also provide some cost relief to preparers so that there's a reasonable balance between costs and benefits is achieved. So finally, we've provided some useful links on slide 25. You can access the discussion paper from here and also the snapshot that provides a simple summary of the discussion paper. The contact details of the investor team are also included, and we'll be more than happy to talk to you separately if you'd find that helpful. Finally, a link to the page on the website where you can submit a comment letter is also provided on this slide. So we have 2 final polling questions before we open up for any Q&A. So I don't know if we can launch the last 2 polling questions, please. Okay, thank you. I can see them now, so hopefully everyone else can as well. The first question is about the measure of equity excluding goodwill, and is that actually a measure that you use in practice? Yes, no, or maybe you use an alternative, so the tangible book value that I mentioned during the presentation, so you exclude goodwill and all other intangible assets. And the second question is about the recognition of all of those identifiable intangible assets acquired in a business combination separately from goodwill, and whether you find that information useful. So there's a couple of yes options based on various different things. So yes, it helps you understand what a company acquired, and yes, the amortization is more useful than including them in goodwill. And there's a few no answers as well to try and get at the reason behind you disagreeing. So it could be that some of the intangible assets have unreliable valuations, some of them are a bit too similar to goodwill and you find them difficult to understand why they're separately recognized, or perhaps you just think there should be a consistent treatment between internally generated and acquired intangible assets. And so if I give you a minute to respond to those polling questions.
Give it 10 more seconds.
Yeah. Okay, so we've got some results. An extremely split answer for question 1, entirely equal. I'm not entirely sure what to make of that response, given there's no clear answer. But I guess if we add the yes and the no, but you do use a tangible book value, it seems that there is some information content in these types of measures, and that might be useful for the board in deciding whether to require that or not. In terms of the second question, there's a pretty clear answer, which I'm not sure Nick will really appreciate the answer to this, because I know he has a different view, but it's clear the majority of you do think that the separate recognition of all of these intangible assets is helpful, and it does help you understand what it is that the company is actually acquiring. So I don't know if Nick wants to comment on that last question, or if we have any questions.
The answer is what the answer is. So
yeah.
We take that feedback on board. So thank you for answering all the questions there.
Yeah. So I don't know if we have any questions from any of the participants.